Welcome to Yahoo Finance Live. I'm Shauna Smith along with Akiko Fujita. Let's get you up to speed on this afternoon's market action. We got about an hour to go until the close. You're looking at the Dow off 55 points, but take a look at the movement that we are seeing in the S&P and the Nasdaq. Still no progress, it doesn't seem, on the talks down in DC, but what's really driving the action today is the results that we got out from Nvidia. You're looking at gains almost across the board when it comes to some of those larger tech players here. You look at the Nasdaq up almost 200 points. That's a 1.5% gain there with just under 60 minutes to go.
Yeah, and Shauna, that is where we are beginning our show here. The stock story of the day, Nvidia, the chip giant soaring on earnings and revenue guidance that blew past Wall Street expectations. At the core of the optimism is AI. Right now, Nvidia is the leader in the market for chips that power artificial intelligence. You're looking at the stock there, up 25% right now, on track for its best day since November of 2016. And Shauna, for those who are sort of now looking at this saying, wait, why all about Nvidia? We're talking about the GPUs, or highly specialized chips that are really the building blocks for this latest advancement we have seen in AI over the last 6 months. I've been looking at some of these analyst calls on the stock, incredibly bullish. HSBC and Rosenblatt Securities most bullish for $600 a share. And there's a number of things that we've heard from analysts today that really point to this exuberance. Some would argue maybe a little irrational, but Truist upping its price target to $470 a share, calling the stock's upside stunning. Susquehanna calling this a gold rush in AI, with Nvidia selling the picks and shovels. And that's all contributing to this huge rally we're seeing today.
It certainly is. And we're talking about a stock that was already up over 100% ahead of the results since the start of the year, ahead of the results that we got last night. So talk about some of the excitement that's playing out in the market. We're not only seeing this in Nvidia, yes, a massive gain there, but a number of stocks that do have exposure to AI are also riding this wave and this excitement here to the upside. We have AMD, Micron, both having exposure to AI. They're in the green today. Google and Microsoft, when we talk about that chat GPT or the generative AI exposure there, those two stocks moving to the upside. And Palantir and Arista Networks are also among the gainers today. Akiko, you were talking about some of the analyst commentary that we're getting. A lot of this comes back to what we heard from Nvidia when it comes to their guidance. And Bank of America was out with a note today talking about the significance of that guidance raise. The company now expecting $11 billion in sales for the second quarter. But Bank of America in their note saying that they've never seen in their coverage anything like this, and that its market cap is on the path to $1 trillion. Not too far from that today and beyond. So certainly a lot of hype here about what we've just heard from Nvidia, but not just that, really about what the company could potentially look like because of the developments in AI a few years down the road.
Yeah, and Shauna, we can trace all the excitement around AI back to November of last year when we saw this release of ChatGPT. Investors for months now trying to figure out how to position themselves for what they see as transformational technology. There's an interesting study I want to point to here from NBER that talks about where the upside could be in AI. They specifically looked at the exposure companies' workforce has to AI and said when you calculate that, the excess returns are 0.4% higher on a daily basis. You see IBM there at the top of the list, Nvidia rounding out the top five, but certainly investors going to continue to seek for any kind of return on AI as we see this hype grow more and more.
Yeah, and look at those price targets. Certainly a lot of excitement about what we heard last night, about what we could potentially see here going forward. All right, well, the other big story of the day is Fitch Ratings has placed the United States top credit rating on watch. This comes as negotiators have failed to reach a deal on the debt ceiling, getting closer and closer to that X date. Well, with time running out, there are talks of a plan to delay non-debt payments. Those talks are starting to surface and gaining a little bit more traction. Here with more, I want to bring in John Lieber, Eurasia Group U.S. Managing Director. John, it's great to see you here, and I know that this is something that you have done a lot of research and a lot of, I guess, just diving into exactly what this would look like. So break down how this would play out and how much time this would potentially buy the administration and lawmakers.
What's interesting about this debt limit is that it's coming potentially on June 1st. So that's an important date because you're only about 2 weeks away from a massive influx of tax revenues that would happen on June 15th, which is one of the US's 4 quarterly filing deadlines. So if you end up breaching the debt limit and the Treasury spends out all its cash around June 1st or June 2nd, which is what Treasury Secretary Janet Yellen has been saying, It's possible that instead of going into default, what you could do instead is delay whatever payments are due on the first and second, particularly payments to vendors or to hospitals or to federal government contractors. And in delaying those payments, wait for your revenues that come in through withheld tax receipts to build up again, and then make everybody whole, buying you time until June 15th, which then gets you additional revenue that would extend the X date by several more weeks and potentially months. So it's not ideal. And one of the big problems with it is that you might end up having to skip money going out the door to Social Security recipients. But other agencies of government have a lot of experience with these kinds of delays, and vendors probably wouldn't mind all that much.
Yeah, I mean, let's pick up on that point. I mean, people hear Social Security and delay, and that alone is cause for concern. When you're talking about non-debt payments, you mentioned vendors like hospitals, potentially Social Security. What about salaries? I mean, what are the other things that could potentially be delayed just to try and save the talks?
Yeah, I mean, the big ones would be any payments to contractors, salaries of federal government workers to the extent they come due on June 1st or June 2nd. Anybody who's getting paid later in the month wouldn't really be affected by this, as revenues would be coming in. All the payments going out to the entitlement programs, a lot of which are going to go to these large hospital organizations and vendors through CMS. And I think the big politically risky one here is going to be the ones that are the direct benefits, like I mentioned, which are going to be the salaries, veterans benefits, Social Security. Those are the most politically fraught ones. But the fact that this would be a relatively short period means that the government may escape relatively unscathed. And at the same time, they keep making their debt payments, which means they avoid default. It's not a perfect option. No one's even sure if it's technically feasible, but it makes a lot more sense than some of the other ideas that have been put on the table, such as issuing new debt under the 14th Amendment, or the minting $1 trillion coin and giving that to the Federal Reserve.
Yeah, John, before we get a little bit into some of those other alternatives that have been brought forward here, in terms of this potential alternative, could it face any legal challenges, or what does that potentially look like?
Yeah, I mean, all of this is new, relatively new territory. The U.S. has never spent down its cash balances and gone past the X date yet. So there is some precedent in the past for the federal government not acting in time to ensure that payments to doctors go out the door. And so the Center for Medicare Medicaid Studies has delayed payments to those vendors in the past, and they can do so relatively routinely. That did not result in any lawsuits, and no one really got that upset about it. In this case, because you'd have such a broader base of people who might be potentially subject to this delay, it could trigger a lawsuit on the fact that they are contractually, obligated to get these payments. Maybe there's some quirk in the Social Security law that I don't know about. So there's a lot of legal risk here for Treasury doing this. But again, it would be preferable to them to do that and get sued than it would be to default.
Let's talk about where the numbers are right now in D.C. You've got about 35 House GOP lawmakers, members of the Freedom Caucus, sending this letter to House Speaker Kevin McCarthy, essentially calling him to hold the line on issues about clawing back some of those COVID benefits or unspent COVID benefits, also clawing back some of that money set aside for additional IRS agents. If, in fact, there is a compromise here that could potentially push the debt limit higher or potentially kick the can down the road, how many GOP lawmakers you think are willing to break ranks? Because right now, we're still seeing a unified face.
Yeah, I think of that group of 35 lawmakers, you're probably going to get about 0 of them to actually vote for the final compromise. I don't think that group is interested in voting for the final deal that McCarthy cuts with Biden. What they want to do is ensure that that deal is as close to their preferred policy outcomes as it can possibly be. So they're the ones who push the $4 trillion in cuts, the 9% cuts in FY24 spending. And so that group knows they're not going to get that stuff. But what they want is to just make this bill as conservative and close to their preferred policy outcomes as they can possibly get. So I would probably take all 35 of them off the table. You still have, almost 200 Republicans who could still vote for this deal, even if that group doesn't. And what McCarthy really needs is to ensure that the deal is good enough that enough Republicans vote for it, and also good enough that that group who doesn't like it doesn't move to remove him from his job, which is really the big threat that's hanging over his head right now.
Certainly set up to be a challenging couple of days ahead. John Lieber, great to have you here at Eurasia Group, U.S. Managing Director.
Well, the pressure to secure a debt limit deal is getting more urgent as credit rating agency Fitch puts U.S. debt on rating watch negative. Yahoo Finance's Rick Newman is following that story. And Rick, a lot of people saying this feels like 2011 all over again, although the downgrade has not happened yet.
Right, and it's really worth going back to 2011 to figure out what might happen if there is a downgrade by Fitch or by Moody's or by any other rating agency. When this happened in 2011, it felt cataclysmic, like this was something that was never supposed to happen, and it might change everything about the way the United States issues debt and the creditworthiness of the United States. And that did not happen. In fact, something crazy happened in 2011, which is you would have expected when your credit rating goes down, almost all the time, you have to pay more to borrow because you're considered to be a riskier bet. The opposite happened in 2011, which is that U.S. Treasury rates actually went down, ironically, because the whole situation sent people out of risk assets such as stocks and into what they considered safer assets. And what did they consider to be the safest asset they could find? U.S. Treasuries, the very asset that effectively had just gotten downgraded by Standard & Poor's. So the United States has continued to enjoy the lowest borrowing costs in the world since then. Now, they've gone up lately as overall interest rates have gone up. But given that we went through this once in 2011 and basically survived with hardly any damage, that could be what happens again if Fitch actually would go ahead and downgrade the U.S. credit rating. Now, Fitch has basically said we're only going to do that if there is some sort of default scenario. And let's remember, let's define default correctly. Default means very specifically not making interest payments on U.S. debt. John Lieber from Eurasia Group was talking before about not making interest payments to, or payments to vendors or things like that. That is technically not default. And that is not something that, in theory, would trigger a credit rating downgrade. But, this is all somewhat uncharted territory. We got a little bit of this in 2011. We could get further into it in 2023. Maybe we will really get into the mess in 25 or 27. Who knows?
Rick, what do you think? I guess, how do you think lawmakers are looking at this warning here from Fitch? Do you think it's adding some urgency to those talks? They should have already been pretty urgent, but do you think it's adding a little bit here just in terms of the pressure that they're facing as we do get closer and closer to that X date?
Not really. So a lot of analysts have been saying that the thing that will really get these jokers in Washington, D.C. to get a deal done is when they start to see real turbulence in financial markets. And the Fitch warning on its own, it has not produced any kind of turbulence in financial markets. In fact, I think the markets are up today, and everybody's talking about Nvidia and amazing results in the private sector, not about what's happening in Washington, D.C. So I think as we get closer to the point at which the Treasury actually cannot make all of its payments, you will start to see more pronounced moves in financial markets. I should point out we are already seeing some elevated interest rates for short-term U.S. debt. There is a bit of a risk premium there because those are that's the debt that in theory might be at risk if there is some kind of default scenario. But I think it would have to get considerably worse than it is right now for Congress to really sit up and take notice. But the closer we get to that so-called X date, the more punchy everybody is going to get, including financial markets.
Yeah, and just a reminder, we are exactly a week out from June 1st and that X date. Rick Newman, as always, thanks so much for that.
Bye, guys.
Well, we are just getting started here on Yahoo Finance Live. Coming up, Nvidia soaring today on high hopes for artificial intelligence. We're going to talk about the impact of AI on markets and investing on the other side. Plus, we are talking the state of travel as gas prices move to on the rise slightly just ahead of the holiday weekend. And New Construct CEO David Traynor joins the show later in the hour to give us his top picks to watch and which ones to avoid. That's coming up on the other side.
Nvidia stock surging after the chipmaker beat on earnings and issued strong guidance, getting a big boost from AI. Here with a closer look at the move higher, much higher that we're seeing in Nvidia. Jared Blickery has a closer look. Jared, gains of 25% today alone.
Yes, you'd have to go back over 6 years, 6.5 years to be exact, to find another day that had better returns. And this is just phenomenal. This is a stock that's already one of the largest in the Nasdaq, already one of the largest in the S&P 500, now sitting at a market cap of $950 billion. And I just want to chart the price action real quick. This is a two-day view, so yes, up 25%. But just want to show you a 20-year as well. And you can see Nvidia really took off. This peak right here was during the blockchain Bitcoin bubble of late 2017. Fell off from there, but you can see it's been off to the races ever since. 21,964% over the last 20 years. And you take a look at what's been happening with the short sellers, not surprisingly, Nvidia short sellers getting clobbered. Nvidia has one of the highest short interests in the Nasdaq, in the S&P 500, and those sellers are looking at a loss today of about $2.3 billion. That's according to S3 Partners. Loss year to date about $8 billion. And let me go back here. Just want to show you what's happening in relation to all the other mega caps. I pointed out that $950 billion closing on $1 trillion, and this is all by market cap right now. That is only behind Alphabet, Microsoft, and Alphabet, and Amazon in the Nasdaq 100 here. So I want to go back, and I just want to kind of compare what's been happening this year. And let me show you some of the year-to-date returns, not only Nvidia, but some of its partners here. And then we can talk about why this is happening. Nvidia up 162%, kind of dwarfs the next best competitor here, Meta, at 110. But all of this is related to AI. It's no secret that we had a terrible year last year. We're in the midst of an aggressive Fed. And what has this been doing? Well, in comparison to some of the other bubbles we've had throughout the years, and I guess we don't know that this is a true bubble just yet, but it looks that way, still relatively small. So here's AI over here. Here's one of the first ones in modern history. This is gold, followed by Japan in the late 80s, early 90s. Then we have the dot-com bubble here. We have the housing bubble. That was actually small, one of the smaller ones here, but it affected a large number of people. We got China here, but it gets really interesting over here because we have ARK Invest and we have Bitcoin. Now, Bitcoin is the biggest bubble of all time, about 1,600%. We know what happened with that, but if history is any guide, guess what? AI could be a larger one. Well, think about that. I think it all comes back to what happens to the debt ceiling, but let's not get ahead of ourselves. We know that we know that bubbles tend to discount fundamentals, Akiko and Shauna.
Yeah, certainly a gain of 25% today, closing in $400 a share.
Yes.
Jared Blickery, thanks so much for breaking that down.
Well, the tech sector, as Jared pointed out, is up more than 27% year to date, driven in part by the excitement around artificial intelligence. As the technology reshapes the sector, where should you place your bets? Let's bring in Omar Aguilar, Schwab Asset Management CEO and CIO. That's a question a lot of people are asking today, given the incredible rally we're seeing in Nvidia. How are you looking at the space?
Well, it's obviously a great story, and I think we have seen from the end of last year, probably like from middle of last year to end of the last year, all the excitement related to the developments of artificial intelligence, and in certain way, that has actually provided a significant amount of tailwinds for the technology sector all through 2023. And that has provided enough stability for the rest of the market. So that's obviously pretty good. I think what is interesting to see about artificial intelligence, it's twofold. On one hand, it is the typical component of everybody being interested about a future potential. The results that we saw from individual companies, especially the one today, obviously generates the fact that there is a significant amount of capital expenditures, there is a significant amount of investments that ultimately generate revenue. There's a significant amount of players that are trying to get into the race to have something related to artificial intelligence. When you have that level of excitement, investments, it's still with a lot of corporations with a lot of cash in their balance sheets. This is a good way to deploy assets so that you can potentially have those future areas. And as we know, in those particular cases, it's all about growth. It's all about future potential as opposed to anything that has to do with fundamentals, which is, a good distraction for everything else that we have seen on the macro levels over the last, several months.
So, Mar, it sounds like you think that maybe some of this momentum is going to continue, at least for this year. When it comes to just the narrow leadership that we have seen in the market, you mentioned the fact that it has been able to really lift up the broader market so far this year. Is that, though, going to remain the case as we look out to the rest of 2023?
Well, if it's a great question. And yes, a big concern of the rally that we have seen in equities through 2023, it has to do with two things. One is definitely the breadth is not there. We have seen that significant amount of the gains in this year, equity markets, particularly in the large cap space, have been driven by a small number of stocks. And when you actually see that, that's obviously a sign of concern, because when you extract tech away from the rest of the market, you actually probably see a more realistic scenario where what the macro conditions will tell you what is going to drive security performance over the next 6 months. When you actually think about the implications of what we have seen for higher interest rates, a little bit more leverage, cash in the balance sheet starting to reduce, that level of activity has gotten us to, earnings surprises that, even though they are a little better, still continue on a downtrend, as obviously the pricing power that a lot of companies had last year is no longer there. So I think a big part of this is yes, there's going to be momentum. It's going to be fairly narrow in certain parts, definitely AI. It's a big driver of that. The rest of the market and the breadth of the market is something that we need to continue to pay attention, especially as we continue to see, changes in the landscape when it comes down, particularly the consumer spending.
Yeah, on that front, have there been any fundamental shifts in the narrative as you see it? If you're talking something like the consumer and the retail space, we've been on a number of calls over the last few weeks. Has anything shifted for you?
Well, the biggest shift, and I think it has been a big surprise, is that the economy as it is today, especially related to the consumer, is less interest rate sensitive than what the original, thought was. And I would probably say that has surprised even Federal Reserve officials. Everybody, thought that, well, as you increase interest rates, you will see that impact into the economy. And particularly, a big part of the economy tends to be consumer driven. That was actually going to slow down, and demand was going to slow down, and therefore we're going to see that downtrend in inflation to be faster, and that's sort of a little bit of the recipe of what the Fed wanted to do. What we have observed, though, is that because of the excess savings that a lot of consumers had during the COVID years, it hasn't been that, change, or that hasn't been as dramatic as people expected. So the lag in terms of the sensitivity of the consumer to interest rates seems to be growing. And it has been, an area of concern for us, because what we can actually see is there's still savings out there, but it's still in the consumer has been completely focused on the high earners as opposed to the rest of the economy. So on high earners tend to be a little slower to spend that cash. On the other part, the rest of the consumer tend to be a little bit more sensitive to housing prices, or tend to be a little more sensitive to changes in certain areas. We haven't seen that yet. And I think a lot of that has to do with unemployment.
Omar, when it comes to some of the big concerns here from investors, debt ceiling negotiations down in D.C., the lack of progress. We just heard Fitch last night placing the U.S. on ratings watch negative as the uncertainty around those talks persists. We've seen this before when it comes to an actual downgrade back in 2011. If we do see a downgrade this time, what's the potential fallout? What do you think we'll see in terms of the reaction, the sell-off in stocks?
Yeah, definitely. Based on the experience of 2011, I would probably say that the market understands what that means in terms of just having the U.S. on a downgrade. And I think the experience that we had back then is that we should expect short-term volatility, to basically take place, and the implications that had to do with certain de-investments in certain areas that required, certain qualifications and certain grades for their investments to actually suffer, as there's going to be some sellout. I would probably say we saw that back in 2011. The credit downgrade is definitely the least amount of the problems that if we were to go into an actual default. So I think while the credit downgrade may not be as welcome to anybody, it still is not going to be as critical as if anything happens now. And as we can actually see in short-term yields, there's a significant amount of premium paying at the moment to reflecting the fact that there's still uncertainty about having a debt ceiling, agreement.
Yeah, even with that said, it does feel when you look at the market action that the Fed is still a primary driver here. We're a few weeks out from the June FOMC meeting. Expectations are now in favor of a 25 percentage point hike to interest rates. Committee members, Christopher Waller, Lori Logan, Michelle Bowman, and John Williams, we've heard them all speak out in favor of raising rates in order to fight inflation. What's your expectation of the meeting?
This has been fascinating. If we have had this discussion, just 3 weeks ago, actually, the market was pricing, a pause for sure, and even just, significant amount of rate cuts, down the road. I think, what has changed is the fact that we saw with GDP revisions today, and we saw with, unemployment claims, that the economy has been extremely resilient, and that has actually provided the Fed, quite a bit of support for, their actions against inflation. I think the biggest question mark is, with a 25 basis points additional, increase in rates, what is the upside when it comes down to the inflation? Clearly, the downside is that this has been incredibly aggressive already. And we also, need to understand that, we had the banking crisis that has created a tightened lending standard that also has created a very tight conditions monetarily, for the market. So when you actually combine tightened lending standards with a potential 25 basis points more for the Fed, that will basically create a very, very, tight, environment for the remaining of the year. So, our position at the moment still being in a 50-50 chance for what we call a hawkish pause, or potential 25 basis points, considering the new data that supports that the economy seems to be stronger, seems to be still growing, and that, the labor market seems to be tight. And again, thanks to the AI, financial stability is there because the market seems to be digesting all these, fairly well.
So Omar, what's the best way for investors to take advantage of all this uncertainty out there and potential short-term volatility that we could see?
Well, what would we continue to encourage investors is to think about the long-term investments. Most likely in this environment, a lot of these portfolios have actually been out of their strategic asset allocation, and try to take opportunities to rebalance their portfolio. Now, what is interesting about this moment, again, we just talk about potentially 25 basis points additional increases in rates. This actually allows you to look at your overall fixed income portfolio and potentially start thinking about, well, if this is going to be the last time that the Fed is going to raise rates, potentially the last time, should we start increasing duration in your fixed income portfolio? And at the same time, use the volatility to potentially use tax loss harvesting in areas that have been lost in price to potentially rebalance your strategies overall. So look at your fixed income portfolio, try to think about at what time do you want to start increasing duration, given that the potential for short-term rates to basically get to the terminal rate is coming soon. And then second, use volatility to try to rebalance your overall strategy consistent with your long-term investment objectives, but to try to take advantage of potential tax loss opportunities.
It's all about balance. All right, Omar Aguilar, great to have you here, Schwab Asset Management CEO and CIO. Thanks so much.
Thank you.
Well, coming up, shares of Dish Network on the rise on news that is teaming up with Amazon. We've got the details for you when we come back.
Well, shares of Dish Network getting a big lift today on reports the company's in talks to sell its phone plans on Amazon. Yahoo Finance contributor Remy Blair joins us from the floor of the New York Stock Exchange with the details. Remy.
Well, Dish Network shares are higher in the session, and heading into the close on this Thursday afternoon, we are seeing shares holding on to most of the session gains. Now, as you mentioned, according to a Wall Street Journal report, the pay TV and wireless company is in talks to sell mobile wireless plans through Amazon. The Journal report says that Dish and Amazon have been discussing an arrangement that would boost the rollout of Dish Network's 5G network, and that these plans could be announced as soon as June. The Journal report also says that the new phone plans could be sold through Amazon's U.S. website, but that financial terms of this deal do remain elusive. On the heels of that report, we saw shares of Dish Network, which have been in battle this year, trek higher and pop above that $7 a share level. Now, keep in mind that Dish is currently a customer of Amazon's cloud computing services. And earlier this year, Dish Network was hit by a cybersecurity attack. It did face challenges with back office problems since that ransomware attack. And back in the summer of 2020, Dish did complete its acquisition of Boost Mobile for $1.4 billion from Sprint. And that deal was part of the government approval process for T-Mobile and Sprint's merger. Ahead of the closing bell, we are seeing Amazon shares trade lower, off by about 1% on the session.
All right, Remy Blair there at the New York Stock Exchange. Thanks so much for that.
Pending home sales at a standstill last month, high mortgage rates and low inventory are keeping buyers on the sideline. And in the latest week, mortgage rates jumped. The 30-year fix now at 6.57%. That's according to Freddie Mac. Joining us now is Jeff Tucker. He's at Zillow, a senior economist. Jeff, great to see you here again. So mortgage rates headed higher for another week here, highest level that we've seen in just about 2 months. How big of a chill is this higher rates environment going to have on the housing market, which is already struggling to regain some of that momentum that it's lost?
That's right. Mortgage rates are in the driver's seat for the housing market this year and really for the last 12 months. Those higher interest rates have taken that typical monthly payment from about 24% of the median household income just 2 years ago, now up over 36% of that typical household income. So for a lot of buyers, they're already stretched to the breaking point by, interest rates closer to 6%. So as it's kind of hovering back up, lifting off closer towards 7%, that's going to push even more buyers out of the running. And for many buyers who still kind of push through and find a way to buy a home, they need to adjust their budget and maybe shop for a smaller home or shop in a lower priced part of town, which is something we're seeing all over the country. That activity and demand is holding up a little bit better in sort of the bargain neighborhoods and cities in metro areas, while it's actually taking the biggest hit in those kind of pricier neighborhoods.
That 24 to 36% jump is pretty incredible when you think about how much buyers were already stretched trying to buy, especially first-time buyers. What does that shift look like when you say we're starting to see a shift in neighborhoods largely because so many buyers are being priced out? What are the hotspots now?
Yeah, so what that actually means is, when we ask are prices falling, for instance, it really kind of depends on where you look. So prices have come down, especially in, sort of ritzier suburbs. So here in the Seattle area, that would be places like Bellevue and Redmond, what we call the East Side, often kind of centered around big tech employers. Sort of these nicer suburban neighborhoods are actually seeing listings kind of linger on the market for longer. Meanwhile, more affordable neighborhoods and more affordable cities are actually still seeing homes sell quite quickly. They're still selling at prices above what those same homes would have sold for last year. That is also kind of affecting the sales mix. So I think it is actually making that median sale price decline look a bit steeper than it actually has been if you kind of control for quality, just because more of that sales mix is moving from these kind of ritzy neighborhoods to more middle-class neighborhoods, because that's where people can still make the math pencil out to afford a mortgage today.
Jeff, you talk about affordability being a huge issue, mortgage rates going back to that, trending to the upside. Do you think we'll see 7% again before the end of the year?
It's certainly a possibility. I think at the moment, there is probably some uncertainty bleeding into the bond market, bleeding into the mortgage market from all the uncertainty about the debt ceiling. So it could be that if that gets resolved in a timely way and the markets finally get a little bit of that relief, then we could see rates kind of cool back off. But if this gets drawn out and kind of gets ratcheted up to the last minute, that could continue to put some upward pressure on mortgage rates. And of course, the other source of uncertainty is, what is the Fed going to do? We're all kind of on pins and needles wondering, are they going to pause here? Are they going to keep hiking? Every day we get more data about the macroeconomy. Even today's release was kind of mixed news, where GDP looked strong, but gross domestic income was surprisingly weak. So someone can kind of read any of this data as glass half full or half empty. And it's up to the Fed to kind of decide which way they're going to read it. And are they going to continue on a hawkish path, which would, I think, make it more likely we end up back towards 7% mortgage rates.
What does all this mean for sellers? I mean, we're talking about higher rates, right? Higher mortgage payments, limited inventory. So you think sellers are in a pretty strong position, and yet we keep hearing about this still being a buyer's market because they can negotiate down even if it's not the price itself.
Yeah, it's a difficult market for some folks to gauge. It's certainly cooler than last spring or the one before, but if you're a homeowner considering selling and you're just going to hold out until things are as frenzied as they were in spring of 2021, you'll be holding your breath a long time, because I don't think the market's ever going to be quite that big a seller's market again. And if you go out and list today, there's still very little competition from other listings down the block. In the first 4 months of the year, we've had about 500,000 fewer new listings come to market than on average in those first 4 months of the year before the pandemic. So it dropped from about 1.65 to 1.15 million, or about 30% fewer new listings. So if you are a seller, you've got a hot commodity, you've got a scarce item that a lot of people do want to buy, even if a lot of them are kind of knocked out of the running by these high mortgage rates. Some buyers are still out there. We just saw the pending sales were down about 20% year over year, but it's looking like these new listings are down closer to 25 or 30%. So demand is down a bit, but supply is down even more, which is good news if you're in position to sell a house right now.
Jeff Tucker, senior economist over at Zillow. Appreciate the time today. Well, coming up, Best Buy topped earnings estimates, but like many other retailers, they raise concerns about the health of the consumer. We're going to break down the numbers on the other side of the break. We'll be right back.
Best Buy shares moving to the upside, looking at gains of just about 3% after reporting better than expected first quarter earnings. But the company did miss on sales and warned that consumers are, quote, exhibiting some recessionary behaviors. Yahoo Finance's Josh Schaefer following this one for us. And Josh, really seems like along the same lines of the theme that we've been talking about with retailers, that cautious consumer.
That cautious consumer, and really what stands out for Best Buy, though, is they think that this is turning right now. So Best Buy has been struggling for several quarters now compared to their COVID sales. They did very well over the pandemic. Obviously, a lot of people were spending on electronics, sort of upgrading even those appliances in their home that Best Buy sells. So they've been dealing with tough comps for quarters now. They've had declining comparable sales for 6 quarters. And now they're saying that they think that this is going to be the lowest that comparable sales will be. So comparable sales were down 10% this quarter. They think that's going to improve moving forward each quarter. Still going to be down for the year, but that's why I think you see the stock up today, is overall they're upbeat on sort of what could change here. They pointed to trends. I guess apparently after 3 years, in the 3 to 7 year range is normally when people replace their electronics. We're now getting to that 3-year point of people that bought a new TV during COVID. There might be enough new technology where in the second half of the year, they might want to replace that technology. So Best Buy thinks that they're sort of going to get a little bit of a seasonality advantage here.
Josh, let's talk about another retailer that's going in the opposite direction. Shares of Dollar Tree down significantly today, out with their earnings. What's weighing on the stock?
Yeah, Kiko, I mean, when we talk about the slowdown of the consumer, you would normally think that a dollar store chain like Dollar Tree would be doing well, right? But it's interesting. They said that they're dealing with shrink issues that you've heard from other retailers, and they're also feeling pressure from consumers. They said the consumers are not buying discretionary goods at the same level they were before, and that's weighing on their business. I think the biggest thing that stuck out to me from the call was them just simply saying, we are no exception. Because again, when you think about recessionary times, potential recessionary times, consumer slowdowns, you normally think of dollar store chains like a Dollar Tree. We're going to hear from Dollar General next week. You normally think that those businesses would be doing well in this time, but right now Dollar Tree just said it's a tough comp out there. It's tough to sell stuff as far as consumer discretionary goods go. So even where things are necessarily or normally cheaper at a dollar store, consumers still aren't buying right now.
See whether or not we see that trend also with Dollar General next week. All right, Josh, thanks.
Well, Americans are coping with a lot of uncertainty in the markets. Investors have their eye on big retail earnings, the drama in D.C. over the debt ceiling, and the exuberance we have seen today around AI. Our next guest has some advice about the best ways to play in the market amid all of the volatility. Here with some stocks to add to your portfolio and some to avoid. Let's bring in David Traynor, New Construct CEO. David, good to talk to you today. Let's start with the one that really stood out to me, which is Ford. This is a stock you really like. Along with GM, a legacy automaker who has really pivoted to EVs. I wonder how you're looking at that stock, because yes, they've made big bets there, and yet they are still, as recent results showed, a long way from profitability, at least on the EV side.
Yeah, and honestly, so is Tesla. I mean, Tesla brags about cash flow, but their free cash flow burn has been huge. Whereas GM have profitable legacy businesses that generate a ton of positive free cash flow. So they can actually subsidize the losses in EV in the way that Tesla cannot. Tesla sold an enormous amount of stock. We all know about that. And they don't make real cash on the business. So we think the EVs are effectively inherently better positioned to enter a new market than even the incumbents. Even the first mover advantage for Tesla is not overcomable. I think it's already been overcome.
So, David, when it comes to Ford's, I guess, potential to really recapture some of that market share that it has not been able to get here from Tesla yet, what does that look like? And do you think they're going to be able to get to that 2 million EV goal that Jim Farley has laid out a number of times?
I think so. I mean, look, they've got a track record of actually mass producing vehicles at scale and with quality. Tesla doesn't have that. They've done it before. I think they will. And we've seen Tesla's market share already see pretty drastic declines in Europe or more advanced EV markets. We think the same thing will happen here. The main difference really, or one of the main differences between Ford and GM, though, in terms of risk reward, which we think is most important. At the end of the day, unless you've got a crystal ball and can predict the future, you need to do the best you can with respect to risk reward. The risk in GM and Ford is extremely low compared to Tesla. The stock prices of both GM and Ford imply large permanent profit declines. No profit growth, permanent profit decline. Tesla, on the other hand, its stock price implies that it's going to be nearly as profitable as Apple. So, there's a ridiculous amount of expectations for future profitability in Tesla, and there's expectations for the opposite of GM and Ford. So you just got a much better situation in terms of risk reward.
Another stock you really like is Cisco. You could argue that's one of legacy tech names. I mean, what do you like there, and how much upside do you see?
Yeah, it's cheap also. We're seeing, not maybe as much upside in a Ford or GM, but there's good 20 to 30% upside, which we think is very strong in a very kind of heady, frothy market. And look, it's like the picks and shovels of the growth in the data business and the growth in the internet, right? I mean, the plumbing and the infrastructure that Cisco provides is going to see plenty of tailwinds for its demand. As demand for data, we all know, is only getting bigger and faster, and we don't expect that to stop. And Cisco's priced at a discount to a lot of these other heady tech names, like an Nvidia, for example, which is priced for perfection. We think you get much better risk reward in a stock like Cisco.
David, what is a stock like Cisco, though? Because we have heard some cautious comments from Chuck Robbins in the last earnings call saying that he is seeing some caution when it comes to their clients. If we were to see a recession, what does that mean for a name like Cisco?
I mean, it's a lot less resilient than more high-end ticket items like a Tesla, or even a more cyclical area like an Nvidia. I mean, everybody's using more data, and think about, again, Cisco more like picks and shovels for that area. And so we think they'll be better off in a recessionary environment. But the main thing is the stock price is so much cheaper. The valuation is so much less. You got a lot less downside to deal with if the economy goes into the gutter.
David, one of the names that you're watching is Kava. They recently just filed to go public. What do you think that setup looks like? Are you potentially interested in a name like that, given some of the underperformance that we've seen from the other names in that space recently?
We think Kava is the next WeWork. We don't think this IPO should actually ever happen. This is a ruse to trick unsuspecting retail investors into buying what is a terrible business. It's burning cash flow. Its cash flow is only going to get worse. And we think the only reason this company is deciding to IPO in this environment, because if they can't get an IPO done now, they never will, because the cash flow burn is going to get even worse. We just published the report on our own website. We're one of the few firms that's going to provide you any IPO research. We're one of the few firms that's going to provide you honest research. And Kava is one to avoid for the ages.
David Traynor, always with the brutal assessment there. Good to talk to you today. Appreciate the time.
Thank you. Thank you.
Given the success of its vaccine and its antiviral medication Paxlovid, you would think that Pfizer would be one of the big winners from the COVID-19 pandemic, but not so much. The stock is actually down 25% so far this year, basically flat, going back to the start of the pandemic. Yahoo Finance senior health reporter Anjali Khemlani joining us now. And Anj, when you take a look at that underperformance there, why do you think that is, and what do you think investors should make of this?
Well, investors have had a pretty interesting look on this stock, and we've seen this pressure on Pfizer since the pandemic times, actually. You saw even with the approval of its vaccines, it didn't skyrocket the way that you saw other of its competitors like Moderna and Eli Lilly with the monoclonal antibody. We did see a note from Goldman Sachs after meeting with management saying, quote, following the anticipated completion of the Seagen deal, repayment of the leverage taken on from the transaction is the top priority for the company, and then incremental share repurchases are also possible. Then management would look to increase the extent of capital they return to shareholders, either through repurchases or greater dividend. And that's something that investors have been waiting to hear. They've been waiting to hear how they're going to reallocate all of that unprecedented COVID windfall. We know that, if you look at that historical data, looking at that stock, it has been largely flat. You've also seen analyst recommendations largely recommend holding the stock, which is has been true for year over year since 2020. I took a look back all the way since then, and it's been a majority of investors saying hold. Meanwhile, Pfizer has been frustrated about this. I've had conversations with CEO Albert Bourla about this exact topic dating back to those first approvals of the vaccine, and he told me as recently as last month, quote, although I'm not happy, all we can do is to execute on our strategy so that investors will see that this is a good growth opportunity. Now we know that some of the pressures facing the the company include loss of exclusivity, those patents expiring for more than a dozen of its products, but they also are looking to fill that pipeline with the RSV vaccine, with the acquisition from Seagen, and a couple other small acquisitions that have taken place. So all told, it's definitely something where it's just a wait and see for this stock. The company saying repeatedly that its stock has been undervalued, and investors are saying, well, we'll wait and find out.
Anjali, you mentioned Paxlovid. It did get full FDA approval today. For Pfizer specifically, what does this mean?
That's right. So now that it's fully approved, we know that this drug can be marketed as well. Up until this point, it was just available through the U.S. government. This falls in line with what we know is expected for all COVID products if they do get to the approval line now that the public health emergency is over. So that is a positive for the company, and still the stock not up on that, just tying back to the earlier commentary. So interesting, but really good positive for the company right now.
Yeah, I mean, you mentioned accessibility now with the FDA stamp of approval there. What have we heard from Pfizer in the past about the reach they see with this particular drug?
Well, it is the only oral drug available. It's a 5-course, 5-pill course, and it is available for, the most vulnerable, the elderly, as well as some younger individuals who are, most likely to be exposed to COVID and have more negative reactions. So this helps to keep them out of the hospital. So this accessibility now opens up availability in pharmacies, in doctors' offices, and the like. So it really gives it a broader range of patients. And this has been one of the problems of accessibility when the U.S. government was in charge of distribution. So it's likely that we'll see some of that movement there.
All right, Anj, thanks. Coming up, we are counting down to the closing bell on Wall Street. We'll be right back with the closing bell. You're about a minute away from the closing bell. Let's take a look at where things stand right now. You're looking at the Dow off just about 27 points, pressured by the losses that we're seeing in Intel. Intel stock looks like it's set to close off at just about 5.5%. We're also seeing some losses in Walgreens and Verizon, the three worst performers inside the Dow. But take a look at the S&P and the Nasdaq outperformance there. The Nasdaq on track to close up over 1.5%. A lot of that being fueled by the excitement that we saw in the markets reflected in Nvidia's stock today following that stronger than expected earnings report after the bell last night. Also some encouraging guidance numbers there from the company in terms of revenue, what they're expecting to see in the second quarter. Of course, that's being fueled by the AI boom. So we're looking at Nvidia up just about 25%, getting closer and closer to that $1 trillion market value. And it's also taking a number of names within the tech sector with it here. Some of those larger tech names like Google and Microsoft among the winners today. Some of its other competitors within the chip space that do have exposure to AI, some of those being AMD. That's one of the winners in today's action, as well as Micron. And then you also have Palantir and Arista Networks riding this hype here, and investors looking past the fact that we still don't have a debt deal in Washington.
And there you have it, the closing bell on this Thursday. Shauna, you highlighted the theme of the day, and that is the excitement around artificial intelligence, with the Nasdaq, the big leader today, up more than 200 points here. The tech sector overall seeing a big win today on the back of those numbers from Nvidia. Of course, there's still a bit of an overhang here when you think about what's playing out in D.C. and those ongoing talks around the debt ceiling, a potential, we should say, credit rating downgrade also sort of lurking in the background too.
All right, let's take a look at some couple of movers here. And first up, shares of Ralph Lauren, a jump of just about 5% here, closing the day in the green after the luxury apparel and accessories company reported a big fiscal fourth quarter profit beat and revenue that topped forecast. It also posted a more than 30% jump in sales in China, with demand in the key luxury market rebounding sharply. They did see some weakness on a year-over-year basis when it comes to revenue in North America and in Europe. But again, it looks like the street's focusing on that beat, focusing on some of the strength at Kiko that they are seeing over in Asia. We're looking at gains of just about 5%.
Yeah, regional breakdown, certainly really an interesting one for me. When you think about the luxury sector, Asia, largely China, was sort of the big driver pre-pandemic. That market has been shut down significantly since 2020. So the comps, when you think about it, I mean, last year we were still in a zero COVID policy over in China. You can expect to see a big rebound there, but 12.7% increase there in terms of net revenue in China, or at least Asia overall, certainly adding to the lift in the stock today. We are also checking in on shares of Toll Brothers, closing the day higher after RBC Capital Markets upgraded the home builder to outperform from sector perform. The firm noting sentiment around the stock is overly negative, and it is expecting outsized order growth. We've heard a lot about home building this week, Shauna, just about number one, material costs, how that's been weighing on things, but also just the demand in the market, just given inventory.
Yeah, certainly. And we're seeing home builders having that edge there because of the fact that they're able to capture more of those potential buyers out there, given the fact that the inventory for existing homes is so bleak right now. When you take a look at this call from RBC, the analysts there citing the improved demand, stronger orders, and also the resilient margins that we are looking at with Toll Brothers. And this is a stock that has performed well since the start of the year. Year to date, we're looking at gains of just about 30%. On a one-year basis, you're looking at gains of about 41%. So housing market has a ways to go. We know inventory mismatch here, the bleak inventory picture, obviously a huge challenge for housing, but Toll Brothers and many of the other home builders positioned well in order to capture some of that demand that's out there. Well, it's certainly been an eventful year thus far for investors, and the chaotic ride is far from over as debt ceiling deadlines and inflation still remain among the top concerns for markets, while investors are also keeping a close eye on AI plays. Nvidia shares rallying today after displaying the wonders of an AI-fueled earnings report. One can say that the artificial intelligence hype is very much alive and well. Here to discuss all of this and more is Matt Kors. He's host of the Matt Kors Show. Matt, it's great to have you here on set. So we're looking at gains of 25% today for Nvidia. You have a great pulse on the retail trader, the retail investor. What has their reaction been to the massive climb that we've seen in Nvidia, and whether or not this hype is going to continue?
Nothing but pure excitement. And I feel like they've been calling it out for actually many months now, because everyone's been using ChatGPT and other just forms of AI. The discussion's been there. And I would say the major names are Nvidia and Microsoft, obvious the connection to OpenAI, but excitement, and hey, the market agrees with it as well.
Matt, I'm going to play the contrarian take here, not necessarily my take, but we have seen excitement around technology before. And I'm thinking about something like crypto, not necessarily Bitcoin, but just what we saw in a player like Nvidia, some of these chip makers, when we were seeing significant upside in the crypto space. How do you look at this in relation to some other emerging technologies and the rallies that we've seen on the back of that?
I guess on a comparative value right now, if you were to do a basic fundamental breakdown, I think most people would agree that Nvidia is, yes, fundamentally overvalued. But then that brings up a very interesting argument of what is value? Is that the full equation? Is value equal to fundamental value, or is there a little bit more of a complication in there? And I would argue that, yes, value is fundamental value, plus more of crowd support, maybe a little hype support, maybe a little bit of riding the wave. So right now, I'm a massive fan of Nvidia, and I think its future over the next couple of years is a very bright one. But in the short term, when you see explosions of this, I mean, it ended yesterday at $750 billion, and now it might be close to being the 9th company being worth $1 trillion. It seems like in the very short term, it's more of a high-octane, volatile trade, and I would be careful in both directions.
Matt, when it comes to that excitement with AI, clearly Nvidia, the massive beneficiary, at least for today, and certainly has been given the position that they do have within the space. But what about some of the other established names that are out there when it comes to Google, Microsoft, even Meta, that has also been riding this AI boom? What do you make about that explosive growth that we've seen in some of those companies, specifically Meta, year to date?
Well, with all of those, I think there's exciting things that are going to kind of play out over the next couple of years. So the first 30, Amazon, Google, Microsoft, they're going to end up vertically integrating, if I had to assume here. They're not going to always just be purchasing their chips from Nvidia or potential competitors if they're able to end up scaling up. But with Meta right now, it feels like at first there was such a focus on the metaverse, and obviously the market reacted very, very poorly to it. And then when you slice a couple of jobs and get a little bit more into AI right now, for a while there, if you said blockchain, 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 your stock exploded. Now all you have to do is say AI over and over again.
We've been seeing that.
And you just add billions to your market cap. That's, I guess, what they're teaching at business school these days.
Matt, that was exactly what I was referring to. Better put than I said about emerging technologies really adding to the exuberance on the market. Let's talk about potential meme stocks, because you've always got a good pulse on how retail investors are framing certain names. Mm-hmm. There's a debate going on about whether these regional banks have been, can we say memeified? Is that a word? I mean, what are you hearing about how they're looking at this space right now? And would you call it a meme stock?
I feel like the term meme stock, and what the retail investors are paying attention to, it's been changed so much over the past 2-3 years now. At first, it was just GameStop because it was crazy what happened. We were all in our sweatpants on our couch. But now just so many things have played out, and it feels as if we're applying the word meme stock to just anything that generically retail is paying attention to, or really just anything that has massive moves. I mean, right now, looking at the crazy movement in Nvidia, why not just call that a meme stock? Because a lot of retail has been making a lot of money. So when it comes to banks, I wouldn't call it a meme stock. I would call it a highly volatile trade. So of course, a lot of retail traders are very interested in it, especially with the explosion of 0DTE options trading. So there's a lot of interest, but in terms of meme stock, I wouldn't necessarily say it really crosses over into that definition quite yet.
And Matt, taking a look at one name that's certainly been very volatile, and I know you've been closely tracking the movements here lately, the losses that we're seeing in Icon Enterprises. So initially we got the short seller report from Hindenburg, and then we also just had Carl Icahn's, I don't want to say enemy, but they certainly do not line up. Maybe they are enemies, it's safe to say. Bill Ackman kind of piling on here, adding some of that fuel to the fire. What do you make of this back and forth, and also just the fallout that we've seen in Icon Enterprises?
Honestly, Nvidia is a crazy story right now, but I think IEP and Icon and Bill Ackman is my most exciting story right now. As I was walking to this set, there's another update that Icon might sue Hindenburg, and they're also considering a share buyback, like literally within the past 5 minutes. So I find it fascinating. Hindenburg making a very valid point of maybe a little bit overvalued compared to the net asset values. Ackman coming out, and I love this kind of coy game that they're playing of, no, I'm totally not in the play. I'm not doing anything. I don't know if he is. I don't know if he isn't. Bill doesn't call me anymore. But anyway, it is a serious accusation, and apparently as the market is really digesting Hindenburg's accusations, they're starting to agree. We've fallen 60%, and even then, relative to its peers, you could argue it's still trading at a premium. And for it being Ackman itself, a player who was notorious for saying, hey, mismanagement and using too much leverage, now that's exactly what he's being accused of. So it's a story of the battling of Goliath, and I'm really enjoying watching it play out.
And so in the last 5 days, off just about 40%. All right, Matt Kors, stick around because we're going to get your take on some of the other trending stories of the day in just a bit. But coming up next, if you're traveling this weekend, it may be cheaper to drive than it is to fly. We're talking gas and oil ahead of the holiday weekend. Stick around.
Well, the countdown to Memorial Day weekend is underway with Americans already taking to the sky to get to their holiday destinations. The FAA says Thursday, today, is the busiest day for air travel ahead of the long weekend with over 51,000 expected flights. So if you're still thinking about heading out somewhere, you may want to drive. Let's take a look at gas prices today. The national average coming in at $3.57 a gallon. That's up a cent from yesterday, but down around $1 since last year. For more on this, we turn to Tom Koza, Opus Global Head of Energy Analysis. Tom, a lot of people thinking back to where we were a year ago. Certainly, what a difference it makes. We're $1 lower, but you know, this is sort of typically the time of year where we start to see prices peak higher. What are you seeing?
I think we've probably seen the highest prices that we're likely to see in the first half of the year. And we saw those in April when we got up to about 367. Most of the information is suggesting we'll wobble a little bit lower. And it's a great disinflation story. You know, you're mentioning airlines. Jet fuel is probably less than half of the price that it fetched last April and May. Gasoline's down by about $1, and it may be $1.50 cheaper by the middle of the month. And diesel's about $1.50 less. So, there's a lot of things can screw up the economy. But right now, energy prices are not among that.
Tom, what about the second half of the year? I know you said that you think we hit a high for the first half. In the second half, though, are we going to head back towards $4 a gallon?
I don't think so. Although I think the tropical storms and the named hurricanes are going to have a lot to say about that. We've added about 1.5 million barrels a day of capacity, and most of the additions have been at the U.S. Gulf Coast, Alabama, Mississippi, Texas, and Louisiana. So if you see probability cones there, you could see some numbers that are pretty spectacular, but hopefully not coming to a theater near you.
Yeah, what does the inventory picture look like? I mean, we got the numbers from EIA yesterday pointing to a surprise drawdown.
Yeah, we're okay with gasoline stocks. We're not using as much as we used from, let's say, 2016 to 2019. So we don't necessarily need as much. And, the driving season is more mythical than real. This is a little bit of a dress rehearsal for the crunch weeks that come, let's say, when all schools have let out around the solstice through the early part of August when some of the South goes back to school. So I think we're okay, but we really do have to cross our fingers for hurricanes, have to make sure that the power grid is stable because you can't operate refineries without electricity. And then the other thing that might make prices wobble a little bit higher in the next couple of months is I think you can make a strong case for crude oil going up maybe $10 a barrel, and that adds about 25 or 28 cents to the cost of gas.
Tom, what about the looming showdown down in D.C., the debt ceiling negotiations? How do you see that? Do you see that impacting the price of crude in the short term?
Well, that is the big macro tailwind, and that's or the big macro headwind, I should say, and that is something that's probably tempering some of the enthusiasm for crude and, for any oil as an asset trade. Let's hope that they don't play Thelma and Louise with our futures here, and they come to some sort of conciliatory measure on that. But I don't think, it may have an impact if we get downgraded. It would certainly have an impact, but let's hope it doesn't come to that.
But what would be the impact if you're looking at it from the energy markets perspective?
Well, if you look back in 2011, we saw oil really move sharply lower when we had that downgrade. So it would definitely devalue the price of crude oil. I mean, the United States is still the largest buyer of crude in the marketplace, and that could really hinder our production, and it would probably hinder, the economy so much that it wouldn't be an open question anymore as to whether we're in a recession and we don't know it.
Tom, what about the OPEC Plus meeting on June 4th, so just over a week from now? Are you expecting anything substantial to be announced from that in terms of policy that could impact the price of crude?
I think low expectations. The one thing, it'll be interesting to see if Russia does anything or says anything. I know today the Russian oil minister downplayed the chance of a cut at that meeting, and that sent prices down about $2.50 today. You've got 8 countries that have already agreed to cut production. The bigger question is, as you get out into late 2023 and 2024, there's a number of those countries want to add millions of barrels a day of production so they can increase revenues. And that's going to be a problem for the cartel to wrestle with a year from now.
Tom Kloza, OPEC's Global Head of Energy Analysis. Appreciate you stopping by.
Thanks. Nice for having me.
Coming up, we are going around the horn and checking in on some of the day's top stories. We'll be right back.
Let's take a look at some of the top trending stories of the day. We have Matt Kors, host of the Matt Kors Show, alongside Yahoo Finance's Josh Schaefer and Alexandra Canal. Let's get into it. First up, we got to talk about the Twitter debacle. Florida Governor Ron DeSantis' big plan to announce he's running for president on Twitter last night. Well, that ran into some technical issues. Elon Musk wanted to host this call on Twitter Spaces, but there was lots and lots of trouble. David Sachs, Craft Ventures, a co-founder here, had to take over hosting duties for a little bit of time. Let's take a listen to what some of that back and forth sounded like between Musk, Sachs, and DeSantis.
Governor DeSantis, are you there? Can you hear us? I think you broke.
I'm here.
I know. I think you broke the internet there. We had over 500,000 people in one Twitter space, and it was growing by like 50,000 a minute. So, congrats on breaking the internet there.
Well, yeah. I mean, try some new things. You're gonna.
Yes.
It's adventurous. You can tell by the some of the mistakes that it's real.
So you can see, obviously did not go as planned. It was, I thought, an interesting idea, a unique idea, Matt, but it was over 20 minutes that those technical difficulties persisted. And by the time that DeSantis came on to announce, only about half the people that had initially been logged on were still watching or listening.
I was trying to stream the whole thing and fill in that 20 minutes of dead air. I didn't know what was going, but it was kind of interesting. In a weird way, I felt like I expected it. Like, of course, it was going to be huge numbers, record breaking, but the news was all super negative, like just like an absolute embarrassment and that type of stuff. And it got to the degree that he took down Twitter. So in a weird way, like, it's a pro and a con. So I think there was a lot of backlash, impressive numbers, but then I was thinking about the real size of it. You need 70, 75 million votes to win. We didn't even get to 1 million. So like, I think there's a couple ways you can interpret it fairly.
I think it's interesting just to see how many people are willing to go on Twitter Spaces that quickly, right? Yeah. The fact that you can get 600,000 people, I think is pretty impressive when you consider how many people use Twitter and to be on Twitter live at that time. Matt, I was curious from like a social media perspective, how much does that 20 minutes matter, you think? Like if you go live on YouTube, are people waiting at exactly 7 o'clock, or do you feel like people are joining, at 7:02, 7:05? How does that part of it work?
I think with this, maybe that's why it felt like less negative to me, because people expect that. Mm-hmm. Like it really wasn't like on TV, if there's a big announcement, we expect the time, but half the time when I'm waiting for the president to make an announcement, I still have to kill another 20 minutes. Right. So that's just the natural delay in politics, and I don't know why this one was any different.
Yeah.
Yeah, Twitter Spaces, I do think have a lot of potential moving forward. Josh Farley, the Ford CEO, he's going on, Jim Farley, excuse me. I was looking at Josh Schaefer saying Jim Farley. He's going on with Elon Musk later today, so I think there's a lot of potential there. I miss the video aspect, maybe because I'm a video person, I'm a visual person. It'd be great if they could find a way to maybe incorporate some video, some remote video on that.
Yeah, that is a very good point there, but I also think it is a pretty smart marketing play, or at least just getting more and more attention on Twitter, because clearly Musk has made a number of changes. He's been struggling to really regain some of the user control that has been lost, or really people no longer going to Twitter, using Twitter like they did. So the fact that he has brought Twitter in the headlines once again, he's now holding this chat with the CEO of Ford. It makes a heck of a lot of sense if he's able to execute this well.
Well, and it's what Twitter was doing before Musk bought it, when you really think about their interest in Spaces over the last couple of years and how they've tried to build out that product, right? This is a product that Twitter was bullish on before Elon bought it because of the town square aspect that you can get with it. You can call people up, you can talk to them. I know sports was very interested in it because it was almost like sports radio, right? Where you can have callers come up and they can talk and then you can make them hang up and you have control over it. I think it's a really fun part of the social media. And it's interesting to see what Elon's going to be able to do with it. If he keeps having these big names, though, it does seem like they might keep having a couple tech issues.
Yeah, a lot of tech issues. They need to make some changes there, that's for sure.
But we're talking about Ron DeSantis, and I want to talk about the company that he's been fighting against a little bit here, Disney. And there's an interesting note out from Citi regarding Disney, and specifically what Disney could do with ESPN. So Citi calling and saying that if Disney were to move ESPN's content all to ESPN Plus, that would be worth $20 a share for Disney shareholders, and they're putting a $22 price tag per month on ESPN Plus. That's the projection that Citi says Disney should put on ESPN Plus, and that's sort of what catches my eye here, right? Is $22, obviously bigger than what you pay for most streaming platforms. But I don't know, Allie, you're a streaming expert.
I was shocked by that. That's the profit maximizing price. $22 to me feels not like that much, especially when you compare it to something like YouTube TV. Obviously, that's a totally different product. You have a lot more channels available, but that's $73 a month. And I feel like a lot of the people I know who sign up for YouTube TV do that solely for the sport. So I think there's even more runway here for ESPN Plus if it goes fully over the top to maybe bump that price up a little bit more and make that transition from linear to streaming that much easier.
They also just signed one of the biggest streamers on YouTube, Pat McAfee. He cut his FanDuel deal, moving over there. So he's literally one of the biggest people. So that's going to bring quite a few. And then even if you look at risk reward, Disney's been coming down. It's around 88, major support at 80, could go all the way back up to 200. So if you're just looking at a basic risk reward paradigm, it is a very interesting play.
You know, certainly. I was going to say it's been struggling now for quite some time. And I also think it's interesting in terms of what Citi said was the two lion's share, I guess, drivers here to the upside, because he says it's sports fans that had already cut the cord, that are relying on ESPN Plus, which currently does not show the NFL or NBA games, which we know is a massive revenue driver and is what is keeping some people from cutting the cord. But that higher average revenue per user number that they could potentially get from those existing ESPN Plus subs, that could potentially make a real difference here in terms of Disney's future with streaming.
Well, when you think about sports, everyone always talks about how you can make so much money off those fans, right? You can get them to pay more to go to an in-person experience. You can get them to pay more for apparel. You can get them to pay more for streaming. And I don't think ESPN has really pushed the button there yet. So it'd be interesting to see how far they can get people to go. I know personally, I'm not going to miss games. You're going to pay for it eventually at some point.
Yeah, people are diehards. They don't want to miss their favorite team.
No, sports fans are hardcore. And you also have a certain sector of the population that are movie buffs, and they are pretty hardcore as well. MoviePass is launching nationwide today ahead of Memorial Day weekend. And guys, we know this company has been through a lot since emerging from bankruptcy. We now are in the MoviePass phase 2, if you will. I'm curious if you guys would be interested in signing up, but this is going to be available. You can sign up through different types of tiers. They range in plans from $10 a month to see 1 to 3 movies in a month to up to $40 a month to see 30 movies. Now, they give you credits, so you can use these credits to see certain titles. But the big issue is
movies. That's a movie a day.
Yeah. Which is a heck of a. Now, I'm assuming that would probably be a low credit film.
Yeah.
That'd be if you're someone that likes the indies. Maybe those that aren't as popular can imagine something like Disney's The Little Mermaid, which is out this weekend. That's going to be higher amount of credits. Yeah. But you have to wonder if the industry has enough movies.
I think you have to be so obsessed with movies to even do the $10 a month one. It seems like just for 2 movies a month.
That's a lot.
But it's cheaper than it would maybe potentially cost you just to go to one movie. That would be my argument. I would never do this.
That's a fair point.
But that would be my argument for why this could maybe succeed this time around.
But I wouldn't even go and see one movie a month right now, I don't think. I go and see movies when they come out, and I'm definitely like to go to the movies, but I haven't been to a movie in a little over a month now. I went and saw Air. And I don't know what I'm going to see next. I guess I would see Mario. Like, you try and play it out in your head, and you're like, how many movies would you go see? I don't know.
I mean, I think it's a great time to drop it with this summer because, like, we're going to have a new Transformers movie, a new Indiana Jones. I'm sure there's a couple Marvel movies coming out. John Wick was out there, and Barbie's coming out. So I think it's a smart time to drop it. And also, what was it, circa 2016, 2017? When it was out, it was kind of viral for a moment there.
Right.
Like,
Movie
everyone
Pass
was talking about it.
Loved
so
Movie Pass.
Now, and obviously the AMC group, which this is like strongly paired up with, they're a very strong devout group as well. So now if we're merging those two groups, I could see a little bit of a virality nature to it for sure.
And I think this time around, it makes a heck of a lot more sense, obviously, from just a business perspective. When they did make the changes back in, when was that, 2017, 2018, when they had it $10 per month for unlimited, clearly that was not going to work.
Yeah, that's not you're not making money on that.
It's a credit system. Those credits fluctuate depending on the time of the day that the movie is shown, how popular the movie is, the list goes on. So this makes a lot more sense. And I do think it is a good idea to kind of win back some of those people who simply are not used to and are not going to the movies as much as they were pre-pandemic. With that said, I would not do it.
I think it'd be interesting to see how it helps food sales, though, at the movies, too, right? If you do get people going more, does that sort of help AMC when you think about what they're able to sell from a food perspective and getting people in that theater more? Because you get the deal on the ticket, but you're still probably buying popcorn every time, right?
And I like your theory that the apes, that they're going to be subscribing to Movie Pass. That's interesting. I guess we'll have to see. I'm sure the theaters are bullish on this.
And they're diehard, so I think that that's a pretty safe bet. All right, Matt Core, it's great to have you here. Josh and Allie, of course, thank you. Well, coming up, the summer box office season is here, kicking off with Memorial Day weekend this weekend. We've got to look at some of the biggest movies over the next couple of months next. Many cities across the country, some homes are selling for tens of thousands of dollars less, sometimes even hundreds of thousands of dollars less than they were just a year ago. Here to explain, Yahoo Finance housing reporter Rebecca Chen. Rebecca, so what's going on? Where are we seeing this and what's causing it?
So numbers that we're seeing show that some of the San Francisco housing are $220,000 less than just a year ago, and this is per house. Experts we previously chatted with say it's because buyers are just not as aggressive in the market. There's not as much wealth in the tech ecosystem, so there's not that much IPO going on. The VC funding has really dried up, and because of the tech layoff. And also, we're seeing that pandemic boomtown prices are really coming down. So Austin, Texas, Boise, Idaho, prices are dropping in these places as well. Austin, it saw a 15% decline this year. It's about $85,000 less compared to last year per house. And Boise, and this is really the market where in the last 2 years, market went crazy it skyrocketed over 40% in just 1 year. And in Boise, Idaho, we're also seeing similar things where it's a 15% drop, and that's about $80,000 less in a house compared to last year.
How does this all compare to where things were pre-pandemic?
So before a pandemic, prices weren't as high, obviously. And for Austin, prices are still relatively elevated compared to pre-pandemic. Based on our calculation, average price is about still 50% higher than 2019. But on the other hand, San Francisco is seeing a little bit more coming back down. So based on our calculation, San Francisco right now sits about within 4% of price difference compared to pre-pandemic levels.
Rebecca, the pressure that we're seeing already on housing prices, is that expected to continue?
So it's a yes or a no question answer, and it's because in addition to the macroeconomic factors, we are also seeing a lot of factors affecting these local markets. So for Austin, the supply has really changed because there are more newer constructions coming online, and there are a lot more listings compared to the rest of the housing market. And on the other side, demand has really dropped for Austin. 2 years ago, everybody somebody was moving to Austin, but this year, we actually saw a negative population growth at the end of last year. So we think because of supply and demand, price is easing up a lot in these markets. But as for San Francisco, because it's such a technology-heavy industry, we're really not sure where it will go next because technology firms could bounce back any second, as we know. But we do know that because of the working from home narrative has changed for the city going forward.
It certainly has changed for a number of cities. Rebecca Chen, good job. Thanks so much.
Well, blockbusters are back. This summer is jammed full of big budget movies, ranging from family films to star-studded action flicks. This holiday weekend, Disney's live action Little Mermaid will be the big movie hitting theaters. Joining me now, Sean Robbins, chief analyst at Box Office Pro, as well as our very own Ali Canal. Sean, it feels like every year we're sort of ramping up to 2019 levels, but we're still well below theater attendance when we think about where things were in pre-pandemic times. Are these the names that are finally going to get people back?
It's creeping ever so closer, it seems like. And, I think this is the kind of weekend the industry has really been looking forward to. The Little Mermaid is going to be a huge draw, especially, I think, for moms and daughters over the holiday. An audience that's really been underserved in recent years, to be honest. But at the same time, we have the second weekend of Fast X. Guardians of the Galaxy Volume 3 has done really well and had great word of mouth. That's a great variety of content to have on not just a big holiday weekend, but effectively the start of summer vacation for a lot of kids. And it's going to build into what looks like a really strong June and July slate as well.
And Sean, I want to pick up on that point because you wrote in your preview that driving optimism is the pent-up demand for a female-driven tentpole. How important is it to have different genres and different types of movies rather than the same old Marvel, Avatar, superhero films that we seem to have gotten used to?
It's priceless for the industry because, look, everybody loves their superheroes, but we want to see a variety of content. Like, If families go out to see Mario, but at the same time, adults go out to see John Wick. That was the narrative, Creed 3 over the spring. We see more of that because that contributes to an overall healthy ecosphere for theaters, for studios, when everybody has something they feel like they want to go see, whether you're a young kid or maybe you're, my age or older, my parents' age. And we have more of those movies this summer because everything from Marvel to Little Mermaid to Oppenheimer and Mission Impossible, the spectrum is really covered.
Sean, we were talking about some of the movies coming out this summer in our meeting today. And I have to tell you, I had a bit of a flashback because it feels like whether it's Transformers, Little Mermaid, Indiana Jones, these are all names that we have heard before. Yes, they are in different iterations, but are we to the point where studios find them as safer bets here? Because it feels like there's a lot of remakes.
It's true. And I think franchises have been the lifeblood of the box office for many years. Even before the pandemic, it's certainly trended in that direction. And that is the reality. They are the cash cows. They are the reliable brands. This is a risk-averse industry. Studios want to invest in what they perceive as the easiest winners, even among winners that are not always easy to generate. And it's created, I think, a cry for more original content. I mentioned Oppenheimer. That will be one of the few high-profile examples of such original content this summer, even though it's based on a real person, but essentially it's original film. But at the same time, I think we can still look to the positive side of a lot of these franchise movies have really been well made recently. Things like John Wick and Creed have been beloved by critics and audiences. So the upside, I guess the glass half full aspect of this is, even though there is still a demand for more original content, maybe something like Everything Everywhere All at Once last year, some of these bigger IP films and franchises are at least being treated with the care that I think audiences want to see, at least more often than not.
And Sean, we were just talking about MoviePass launching nationwide just in time for the summer box office season. What are your thoughts on the return of MoviePass? Could it make a difference domestically here at the box office?
It's going to be fascinating to watch. I hesitate to make too many predictions just because it's been such an interesting journey over the last decade for that company. But I think it, in broad terms, speaks to what people are looking for. And subscription services have really become the name of the game for every household during the streaming age. To apply that to movie theaters and to already see exhibition chains such as AMC's A-List doing well, Regal has their own as well, over the last few years with similar structurings, I think there's still an opening here for MoviePass and maybe even other competitors in the future. It's just about getting that model and making it and fine-tuning it in a way that works not just for the company financially, but also for consumers from a practical standpoint.
And we have the Hollywood writer's strike. It's ongoing, no end in sight at this point. Experts have said it likely won't impact the 2023 box office, but depending on how long this goes, 2024 could potentially be impacted. How much of a risk are you viewing a strike, especially since that production pipeline is so important to the box office?
That's a great question, Allie. And it is something I think that is kind of a looming minor concern, but it becomes a bigger concern with each passing week that the strike goes on. And that's just kind of the reality of the industry. We have to look at the timetables, the lead time for productions on especially major films. As you mentioned, it shouldn't have much impact on 2023's releases. But as we look at 2024, which at the moment has a pretty strong slate up and down the calendar, some of those productions could be impacted or delayed. And we saw that happen about 15 years ago in 2007, 2008, when films like the first Transformers sequel was impacted and notably received poor reviews from audiences and critics, in large part as some creators went on to blame because they didn't have enough time to finish the script. So it's really tough to predict and say which ones will be impacted more than others, but it's something I think that the entire industry is going to have to look at over the next few weeks and the next few months.
So, Sean, we've talked about the wide range of blockbusters that are set to be released. What's the one pick you have? Your must-see?
My must-see, that's a tough one. You know what, I grew up a huge Indiana Jones fan. I grew up seeing the Mission Impossible movies when they first started coming out. I'm a huge Nolan fan. So really, to me, there's like a 4-week window in late June and early July when all 3 of those movies come out. For me, that's like the time on the calendar I think I'm most excited about this year.
Wait, Sean, Barbie or Oppenheimer? That's the real question.
You say Barbie.
At the box office, I don't know. It's a coin flip. I think that's going to be such a fascinating weekend to watch. I think they both could do really well.
That's a diplomatic answer. Sean Robbins, good to talk to you today. I appreciate the time. And of course, our thanks to Allie Canal. Well, from the debt ceiling to the Fed, there are a lot of things in the mixing pot for the economy. Yet the recent recipient of the Outstanding Portfolio Manager Award from Morningstar is voicing a relatively optimistic tone on the U.S. economy. Yahoo Finance had a chance to speak with the voice behind the optimism earlier today. Here's what Rick Ryder, BlackRock Global Fixed Income Chief Investment Officer, had to say.
If you look anecdotally at data, and you could say, gosh, I saw, rough, by the way, if you look at surveys, and I always find, I think the markets overestimate surveys. They tend to move with sentiment like the equity market. But if you look at hard data, and if you think about where we stand today, you've got an unemployment rate of 3.4%. You've got wages at over 4%. They just revised up the excess savings in the country. I think it's now 1.9 trillion. You look at the consumer, like you were describing earlier, consumer pulling back in some areas, being a bit more prudent. There's some disparity in terms of lower income, higher income that's going on there. But if you break down the component parts and you think about, you've got a consumer that's in good shape, then it's spending. You've got construction in this country that continues to be durably strong. You certainly see it from things that come on the backside of the IRA. You certainly see it. Actually, home building, you see some of the home builder results has actually been solid. That's a big component, and that's actually doing well today. You're going to get some investment in CapEx, in hard CapEx that's going to come down. But then you've got this technology spend that is in real CapEx dollars. So when you break it all down, you look at the component parts, economy's actually in pretty solid shape today. So listen, if you said to me one thing that is trickier is inflation is we have an economy that's in good shape that's slowing. It's not slowing. I think the argument we're definitely going to recession, I think, is dubious. The question is, can inflation come down enough to hit the Fed's target? And that's the one that is not clear at this point. I mean, inflation is stickier than I think a lot of people thought heretofore.
So you talk about one headwind, Rick. Diane here, by the way. Hi. So I got to ask you about another one that's immediately top of mind right now, and that's the debt ceiling debate that's happening. We've been here before. Markets don't seem as rattled this time around as they did back in, say, 2011, and when you had the S&P downgrade the U.S. credit rating, never restored it. Now Fitch threatening to do that now. Should the market be taking this be more nervous than it is?
So I think the markets is taking the statements that are coming out that there will be an agreement, that the U.S. is not going to default on the debt. I think the market's taking that to heart. And like you say, has generally written off that we're going to have some tumultuous disruption in terms of the debt. Do I think that's right? I generally think that's right. I think the one thing that is important, and I think people need to think about, is the more that the government feels the need to continue to do this and have this debate. The dollar. We live in a world today where it's different than it used to be. The dollar was always the flight to quality. Let's go into dollars if there's any risk. The world is changing. Deglobalization, post-sanctions, et cetera. So it's something that I watch quite a bit. Quite frankly, I've been investing more in emerging markets because I think the persistent rally of the dollar that we saw last year, I don't think you see that again. And, the emerging markets give you an awful lot of yield, and the growth in some of the emerging markets areas is pretty generous. So that, to me, is the part that, we're spending some time on. But listen, by the way, it's not done if they come out of a room and say we have an agreement. You still got to go through votes. And so it's not done. I think one thing when you say, people are generally not long the equity market, and certainly high frequency players are not long the equity market. What is happening is people are long an immense amount of cash. I haven't seen anything like this in my career. There's almost $6 trillion sitting in money market funds. The money keeps flowing in because people are, I want to sit back and wait, and you're getting paid to wait. These yields. You talk about Treasury bills yesterday got to behind 7% for that short maturity. But generally you can buy Treasury bills in and around 5%. You're getting paid to sit in cash, and that's where people are pulling back and saying, I'm going to hold a large cash position.
And it doesn't seem like necessarily that even this debt ceiling situation would change that. We've been talking a lot about 2011, right? And even after the debt ceiling crisis was averted, the S&P downgrade came, and people still bought treasuries, right? Are we going to see, even if the most dire predictions come true, are we going to see a similar pattern this time?
Yeah, I think people are comfortable that even if you have some breach and some form of default, that you're still going to get paid, and that, gosh, there are not a lot of alternatives in the world that are as safe as treasuries. People will feel comfortable being in treasuries. Could you have, and it's part of why you're seeing, I've never seen the spread between in literally a week's term in terms of different maturities of treasury bills. There were treasury bills, really short-end treasury bills yesterday trading at 2.5%, and the ones right after the June 1 date were trading at over 7%. So people are like, I'm going to manage that, but I think generally people feel good about owning treasuries. And listen, I think you would take the government at the word that you're going to pay, they will pay principal and interest. And I think that's right. You think about the ramifications of not. Treasuries are the collateral for the way global commerce works. Dollar is a reserve currency in the world. How we build every asset valuation in the world, debt, equity, everything, or certainly on any U.S. asset, is based on, I got to know the risk-free rate. Once I know the risk-free rate, I can then start taking my decisions around what return hurdle do I need for other assets. Once you breach that, that's chaos. And I think government officials understand the ramifications of that.
We are watching shares of Costco after hours. Big swings after missing third quarter earnings estimates. Yahoo Finance's Brooke De Palma has a closer look at the numbers. Pretty muted reaction here, Brooke.
Yeah, pretty muted reaction. We saw aftermarket trading go down about 2 to 3%, but now largely flat here, but certainly giving us some color on how this consumer is doing as inflation continues to take its toll on consumers' wallets. We saw same-store sales coming up 0.3%. U.S. same-store sales coming lower, down 0.1%. Canada down as well. And international growth, where Costco continues to make a big play and certainly try to boost its presence there, coming higher, up 0.4%. Now, largely what we've been seeing lately is consumers switch to food and staples and move away from discretionary items. Perhaps this a reflection of that, as noted in their April sales results. But in addition to that, we're also seeing Costco emphasize e-commerce sales as they continue to make a play there. We do know that e-commerce sales dropped about 10% 10% in the latest quarter. And in addition to that, also membership fees, something that analysts in the street are watching closely. What we know is that membership fees are roughly changed or increased about every 5 years. They were last increased in June of 2017. And that would bring this next increase to right about now, 2023. While analysts on the street are saying that they do, in fact, expect an increase soon. There was nothing in the release that indicated, of course, we have the call in just a few minutes. But what we do know is that those membership fees that are about 60 to 120, depending upon which one, rose to $1.04 billion, and that's up from 984 billion last year, a year ago. And so largely the Wall Street as well as Main Street looking for a closer look at, just if they do increase those membership fees.
Okay, Brooke, staying on retail, Walmart's annual shareholders meeting quickly approaching. I know you're heading out there. What can we expect to hear from the retailer?
I'm not alone and the only person heading out there. There are thousands of people who are gathering in Bentonville, Arkansas next week. And here are 3 key focus that the street, as well as associates, are looking for updates on at Walmart, really looking to tout automation, their alternative businesses like ad revenue, as well as the new market fulfillment center that they announced this week. Diving into that, what we know is that earlier this year and beginning of April, they did announce that they're investing heavily in automation. They said that the year end of fiscal year 2026, it aims to have about 65% of its stores serviced by automation. So, of course, AI being a key word this earnings season, we certainly expect to see more there, also, as well as their alternate business as the company looks to compete with Amazon. And the market fulfillment center, this is the first one ever. We're going to get a closer inside look at what exactly that fulfillment center looks like attached to a store, as once again, they continue to compete with Amazon, especially online.
Okay, we'll be looking out for your coverage. Brooke DePalma, thanks so much for that. Costco, of course, one of many names moving after hours. Shauna, what are we watching right now?
Akiko, we have a couple of other names for you. Mixes of gainers and losers here in after hours trade. Let's kick it off with Gap because we're looking at a gain of just about 16%. Following their most recent earnings report here, upbeat results from the company, better than expected earnings, margin improvement, cost-cutting efforts really starting to pay off. Also, inventory improvement. Certainly a theme that we have heard about this earnings season. Inventory falling 27% on a year-over-year basis. Now, all of this overshadowing the losses that we did see in comp sales across all of the brands here. That fell just about 3%, mostly driven by the large drops that we saw in Banana Republic and Athleta. The company also saying that it's still searching for a permanent CEO. We know that has been an issue for shareholders, for analysts lately. Year to date, we're looking at losses of just about 34%. Moving on to RH, another retail play here. That stock off about 3% in extended trading. They cut their full year margin forecast, saying that they'll likely have to offer more markdowns as a result of the need to clear some of that inventory that it cannot clear. That also, a week ago, we heard from the 13F filing from Berkshire Hathaway, Warren Buffett's company there, that they did sell their stake in RH. So another problem here for the company here going forward. Year to date, we're looking at losses of just about 5%. Ulta Beauty, the cosmetic play here, down just about 9% in extended trading. They did temper their margin expectations. That is weighing on the stock in extended trading. Now, in this release, the company did note some of the challenges that they face due to theft, something we have also heard from other retailers this earnings season. The company saying that organized retail crime increasingly a challenge here. Year-to-date shares are essentially flat. And rounding out with Workday, that's a big gainer after hours, up just about 8%, a beat on both the top and bottom line. Subscription revenue up 20% on a year-over-year basis. The company also announcing a new CFO, Zane Rowe, formerly the CFO at VMware. This company also was one of these names to mention AI in this earnings release, writing, quote, "We remain committed to innovation and infusing AI across our entire product portfolio." Year to date, we're looking at gains of just about 17%.
Gotta sprinkle in AI in those calls. Thanks so much for that, Shauna. It is closing time here at Yahoo Finance. Time to get you caught up on some of the biggest stories of the day. The Dow ending the day pretty flat as investors wait to see if there is some kind of deal on the debt ceiling before the long holiday weekend. The deal impasse has gotten so bad that ratings agency Fitch warned it may downgrade the U.S. credit rating.
It was a huge day for Nvidia. Shares ending the day 24% higher after a big first quarter earnings report and upbeat guidance, all thanks to AI. It led to a number of analysts raising their price targets on the stock and pushing that stock towards a $1 trillion market cap.
And finally, Costco's third quarter results missed analyst estimates. The retailer's adjusted earnings came in at $2.93 a share, compared to an estimated $3.30 the street was expecting. Same-store sales also came in lighter than expected as consumers pulled back spending on big-ticket items.
All right, well, that will do it for us today on Yahoo Finance. Thanks so much for tuning in. We'll see you right back here at 3 p.m. tomorrow. Have a good night.